2019 was a strong year for investors, but what's in store for 2020? Hello and welcome to Vanguard's quarterly economic and market update for December 2019. I'm Aidan Gayson, Vanguard's Senior Investment Strategist. So let's start off with a short recap of the last quarter of 2019 and then I'll cover Vanguard's outlook for the year ahead. In 2019 it was very much a case of expectations versus the reality of what actually happened. The December 2019 quarter capped off a very solid year, with major equity markets including Australia's on average closing 20% higher and the returns from fixed interest nearing double digits. The strong returns were despite increased market volatility during the year. At the start of 2019, expectations were for a mediocre year ahead. Central banks were expected to raise interest rates through the year, which would have dampened investment conditions. But the reality was quite different. To stimulate economic growth, more than half of global central banks instigated rate cuts, which included 3 by the Reserve Bank of Australia. These cuts were the key driver for markets in 2019, as investors hunting for higher yields turned their attention to equities, while inflows into low-yielding bonds spurred a rally in prices. What we've seen is that many investors have seen the current market conditions as an opportunity to pile into risky assets. While equity markets continue to set new records, there is a risk they are getting ahead of themselves and are pricing in too much optimism for what remains largely uncertain outcomes. Weakening economic conditions, unresolved US-China trade negotiations, the impacts of Brexit and rising global geopolitical tensions paint an uncertain outlook for markets. These factors and unpredictable policy making are likely to reduce demand in 2020 and supply in the long run as businesses defer new investments. Investors should therefore expect a deterioration in economic conditions, which will flow through to investment markets. Vanguard's near-term outlook for global equity markets remains guarded. The chance of a large drawdown for equities and other high beta assets remains elevated. We believe equity returns over the next decade will be modest at best. The fixed income return outlook also has fallen because of declining policy rates, lower yields across maturities and compressed corporate bond spreads. Over the medium term, we expect central banks will eventually normalise monetary policy, thereby lifting risk-free rates from the current depressed levels. Given our outlook for lower global economic growth and subdued inflation expectations, risk-free rates and asset returns are likely to remain lower for longer. It will be a challenging period for investors, especially those relying on stable income streams, such as retirees. As such, this will be an opportunity to work with your existing clients on resetting their asset allocations based around their specific goals, with a focus on diversification and reducing investment costs. If you enjoyed this snapshot of Vanguard's views and you'd like to learn more, take a look at our full December quarter asset allocation report. Thanks for watching.